uh, as the price of silver, especially, rose rapidly, a lot of people entered the market using CFDs, that's contracts for difference, which obviously lay off their risk in COMEX and other places like that. But when you use CFDs, you typically have a 10-to-1 leverage ratio. You can use more or less depending on where you do the business, which means that the CFD provider, this would apply also to people trading futures, but in a slightly different way. The CFD provider is going to put in place an automatic stop loss, whether you like it or not. That stop loss might be adjusted according to how leveraged you are, how much money you've got in the account, and other factors. But in general, when people are trading CFDs, they're trading on a leverage basis. And we had people all around the world doing that. And ultimately, those risks are laid off via COMEX and other places with what's called stop losses. Stop losses are trigger points, price levels at which a position will be automatically closed. And if we're talking about someone who's long, closed means they sell their position if the price goes below a certain level. And the reason the CFD companies or betting companies do this is to make sure they never get into a situation of a loss. So as the price starts to decline a little bit towards the level where the CFD company could lose money, or on COMEX where the broker could lose money because his client has got a position, they will say either to the client, stump up more money, and that's and typically you have to stump it up immediately to make sure you're covered for after the price decline, or more likely, especially in the case of the contract for different sites, it's a stop loss, which is a hard one, which will be automatically triggered at, let's say, 5 or 7% away from the. Let's say you've got 7% running, and the price has gone down by a couple of percent. You're immediately getting too close to the point where you're losing money, and it'll automatically trigger the stop loss. So each stop loss, as it's triggered, causes an instant sale. Now, that sale doesn't automatically happen at the stop loss price. It happens at the next price traded after the stop loss has been touched by somebody else. Now, in a normal market, that often means you get the stop loss price because there's an army of people willing to sell at a certain price. So the first one sells at the stop loss price, but there's an army of people willing to buy at the stop loss. So it touches that, but you can come in second, third, fourth and get the stop loss price too. But in a fast moving market, especially the one we've seen, there won't be so many buyers sitting there to absorb your order. So when your order goes through, someone touches, let's say $110, which was your stop loss, your next trade, you'll get the next trade, which might not be at $110. It might be $109.95. But of course, there's going to be another person with a stop loss at $109.95. So his stop loss gets triggered and he gets traded at, let's say, $109.85. And guess what? There's another person behind that with a stop loss of $109.85. And so it goes off. So we then have this cascading series of stop losses, each one creating a sale, driving the price a little bit lower, which then triggers the next one below, and so on. And of course, there would have been millions of these stop losses sitting around in different places all around the world. And obviously, a lot of people got the money they had in their CFD accounts effectively mostly wiped out by that fall.
Government says 50,000 new jobs. Real number? Employment down 900,000 since December. Whew. Population up 5.6 million. They revise old numbers down to fake growth. Wealthy aren't buying gold for profit, it's insurance. Debt spiraling. Something's coming. Silver crash wasn't manipulation, just stop losses triggered like dominoes. Physical metal isn't for trading, it's survival. The system is rigged.
When we had the announcement of Kevin Walsh being appointed as the new chairman of the Federal Reserve to replace Jerome Powell when he retires in May, Kevin Walsh was seen as a surprise in terms of what people knew about him, because when people looked him up, they found that he was a person who could be a staunch defender of the Federal Reserve's independence, and the kind of person who probably wouldn't agree with quantitative easing. And that was based on his tenure as a board member on the Fed back in 2011. And we'll find out if that's really the case. But I think that was the spark which lit the fire. So if you think about a forest that's full of very, very dry wood, you never know when it's going to burn, but it's been there for a long time. The wood's dry, getting drier and drier, and then suddenly there's a spark and the flames spread. So that was the spark. But what caused the flames to spread? What caused this cascade of selling? What's going to happen is that silver will trade in that inside that band of the top and bottom for a while, and then at some point it will break out to one side or the other. And if it breaks out to the downside, I think we probably go as low as 50 probably. That's just a guess. I don't know that. And if we break out to the upside, I think it's on the way to, well, much higher levels. I would say 150, maybe even $200, which is the supply-demand imbalance and the geopolitical situation and the uncertainty around the world, which means that, in my opinion, the demand for silver is going to continue, not only from industrial users, but it's also going to continue from investors who will say, I'm going to go down and buy myself a few silver coins just because I want to get started. So I think that's going to continue. So I'd rather go for the upside. They should be buying the physical metal because they want to have something they can keep forever, a parachute, an emergency fund, and something which will hold its value over the very long term and hold its value in a way where you do not need permission from anybody else to touch it or take it or use it. That's physical for you. And given the way the world is going with all kinds of geopolitics and bank seizures and sanctions and all kinds of things, I can see that the number of people who'd like to have something outside of the financial system is not going to go down. So that's that's the positive side. But you shouldn't be doing that thinking, gosh, I'm going to, if it goes up, I'll sell it. I'll buy some insurance today, but if that forest fire gets closer, I'll sell it and make a profit. It's like being on the Titanic, right? You're on the Titanic, and there's only a certain number of life jackets, and you happen to earn a life jacket, and the price, and then it hits the iceberg, and the price of life jackets goes up because there aren't enough for everybody. So you say, great, I'll sell my life jacket at the higher price, but then the water starts coming in the ship, and you want to buy your life jacket back. What do? Well, you might get to the point where nobody's going to sell it to you. So it's like that with gold and silver. You don't know. You shouldn't be trading it. You shouldn't be buying and selling it based on the price, because if at the end of the day you're keeping it for the disaster. You're not. And maybe to pass down the generations. You shouldn't be keeping the physical to trade. If you want to trade physical, if you want to trade to make a profit, the way to trade to make a profit is to trade the futures or trade the ETFs. Of course, you're trading paper, and I'm not saying to people you should own paper because that's not what I'm talking about. So, according to the screenshot I took of the December 2024 number, that's 2 years ago. Or 1 year and a bit ago, in December 24, there was 159 million people employed. In fact, it was 159.9. So let's call it that number here. Let's call it 160 million people were employed. Stop that. My phone's ringing. 160 million employed. I looked today, and here's the number in January 2026. It's 158 million. So it's gone down from 159.5 million to 158.6 million. So it's down very approximately by 900,000 people. So as of today, in January, the January number, official number, this is the government's own number from their website, 900,000 people less are at work than there were a year and a month ago in December 2024. Yet every month we've had this positive number showing lots of new employees. So what's going on here? To get to this positive number of new employees, more people working, they've been adjusting the old numbers backwards and downwards. If we go to the same date, December 2024, we had, according to their numbers, we had 269.3 million people in the United States. According to their own numbers, we now have 274.9 million. That's an increase in population of 5.6 million. So what we've got here is an increase in population of 5.6 million, but nearly a million less people working. But the officially unemployed was a year and a month ago 6.88 million. And if we go to today's number, the one which has just been announced, the number of unemployed is 7.36 million. So a good 500,000 unemployed more than there was a year and a month ago. I just can't help smiling a little bit at the how the numbers can come out every month with a positive spin when, you know, if you look at the hard data, it doesn't stand up.
Yeah, and what do you think this means for the economy? Is it that maybe the strong data is sort of misleading, or do you think maybe the GDP growth is actually disconnected from employment because of AI and other trends?
Yes.
And maybe there's, yeah, you think that's the case?
The latter. We've got a two-speed economy. We've got a large number of people who are struggling a lot, you know, to the point where they've had to give up looking for a job or draw benefits for unemployment, because you know, it's hard to put food on the table for their children and pay for education, all the other things that they've got, the mortgage and the rent. And then you've got another group of people who are in the highly paid jobs, and quite often husband and wife working, which is almost a necessity these days. And you know, they're doing all right. So that's probably sort of a 30-70 split, where the 70 are struggling and the 30 are doing okay. When you buy physical coins or bars, you've got a dealer markup, which covers the cost of making the coin, it covers the rent, it covers the distribution costs, and it covers the dealer's time and everything which goes with it. So you're paying well over the odds for the silver or gold content. And in times of stress, that premium will increase. But you go and try and sell it back to the dealer, he's not going to pay you more than usually not much more than the gold price, if at all, or much more than the silver price. Of course, you could sell it privately if you wanted to, and probably capture roughly the same sort of premium. But the trouble with that is you've got to find a buyer somewhere. And that's not so evident, and it's got all the risks which go with it, unless you're dealing with a trusted counterparty. So, you know, obviously, if you go back to the dealer, there is the convenience that you just go to one place and he's going to take it off you. He's going to give you a price, but you might not like the price, but at least he's always there for you. But as I say, the price at which he'll sell to you will always be somewhat higher than the price at which he'll buy back on the same day. So that's, you know, I don't ever say people should buy physical to trade, and people are starting to see that. So what they're doing is, rather than say I'm buying gold for the keep pace with inflation, a rather dull, boring asset, you know, Warren Buffett has said it's a pet rock which just sits there and looks at you. They're now starting to say, what if this does go horribly wrong? What if the government doesn't cut spending? What if the government doesn't raise taxes? What if the situation just gets worse and worse, as seems to be happening? Well, you know, we're at 5 minutes. It looks like we're at 5 minutes to midnight. What's my plan B? Well, I'll get some gold, because I know the gold will be there when we get to the other side of whatever's coming. Don't know what's coming. It could be, you know, it could be a bail-in, it could be a hyperinflation, it could be just high inflation, it could be it's unlikely to be a default. It could be some capital controls, it could be an alternative currency being issued, it could be ration coupons. There's many potential scenarios where some rather drastic action might be taken to rein in let's say, a financial crisis for the government. It might be a situation where people are forced to lend money to the government at a certain rate. You know, all pension funds have to invest 70% of their money in government bonds. They can think of whatever rules they like. And people are starting to say, well, I need a plan B to get to the other side, because I don't know what's coming. So I think what's happening now is people are starting to front run the unknown. Kind of like buying an insurance. You've got a house, there's a forest fire, it may be 100 miles away, but it's coming in your direction, and you think, now's a good time to insure my house. and you don't really care that the price of insuring your house now is more expensive than it was a year before before the fire started. You just say, I'm going to have that insurance whatever happens, because the consequence of things going wrong would be disastrous for me. So I think people are now rushing to front run a future which we don't know if it will happen, but a future which is certainly seen by many as possible. And so that's why they're going for the gold. But now that brings me to the silver, because of course silver is the poor man's gold, so they say. The price is considerably less. You could get you get 50 ounces of silver for 1 ounce of gold, roughly. What does that mean? It means that the silver is much more divisible and much more usable for smaller transactions than gold is. So if you see or fear that the currency system is going to break down, you probably want to have the smaller items that other people are going to accept, because it's you can't go and buy a loaf of bread with an ounce of gold costing nearly $5,000 today. And of course, in a currency breakdown, it won't be $5,000. It'll be so sought after that you can't imagine how high the price would be, and nobody's going to. So you don't want to be spending that on your loaf of bread. So that's why I think people are now starting to say, as well as gold for the long-term savings for the bulky stuff, I need to have a lot of silver just in case.